Hello, everybody. This is Scott Shamber, and we are about to kick off our webinar, our fireside conversation for today. We still have people coming in, so we're going to give a second or two for people to still join us. I guess maybe two. Not everybody is as Swiss as we are. We had a plan to actually hit go at 5:01 Swiss time, and that's exactly what we did. So let's just wait for a couple more minutes here and see who else will join us, and then we'll get going. So I think we can slowly get into gear here. I'm going to kick us off for the day. Welcome. We'd like to give a special shout out. I see Matt and Tarita from the Cook Islands in New Zealand are actually joining us. Also a special hello to Sergio, Helen, Joshua, we haven't talked in a while, Tony. People are joining us from all across Europe, the US, Dubai. So it's really exciting. We have a really a diverse group here. Let's get started. Welcome to our fireside conversation today. High time for alternatives from precious metals to crypto. For those of you that are joining us for the first time, the fireside conversation webinars, we started those as a result of COVID because actually we had been doing one or two conferences or our own briefings or inner circle meetings every year. And just as time went on, obviously COVID didn't make that very possible. So we started these a while back. This is actually our third series. And we're doing this one on the back of our special report that we wrote for the very end of 2021 called The Emerging World of Digital Assets, Why and How to Participate. My name is Scott Shamber. For those of you that do not know me, I'm a partner at BFI Capital Group and the managing director of BFI Bullion, the group's physical precious metals purchase and storage offering. I'm going to be your host for this and future conversations. Just a couple housekeeping items here before we welcome our speakers. Running time today, we're going to go until the top of the hour, so roughly an hour. But if we have enough questions coming in, we'll stick around a little bit and go as far as 6:30 Swiss time, if that's how it works out. So we will see how that runs today. Speaking of questions in a Q&A section, we do have a chat function here. We didn't activate the Q&A function, but we do have a chat function. So feel free to write in if and as you have any questions as we go forward today. At the end of the webinar today, there will be a survey. So would really appreciate your feedback there. And especially if you have any specific questions or you want us to get back to you on anything, you can feel free to leave your details there privately. Of course, everything is anonymous. So let's dive in and introduce our panel. I'm going to start off with Suna. Suna is the head of digital asset solutions and senior relationship manager for BFI with a focus on family offices and digital asset investors and entrepreneurs. He also sits on the advisory board for the BFI Capital Group. And on top of the 20 years of experience he brings, he's also my go-to guy when I want to talk about the NBA, the National Basketball Association in the US. Suna, welcome.
Hey, Scott. Good to be back around the digital fire with you guys. I was looking forward to the real events. I hear we have Bahamas sketched out in the future. So, but obviously we stick to the digital fire for now.
Exactly. Then Daniel Zurbrück is the managing partner and CEO of BFI Infinity and a partner of the BFI Capital Group. Prior to joining BFI, he founded and managed his own independent investment firm. It was the firm that merged with BFI Wealth Management to form what BFI Infinity is today. And Daniel is my go-to guy when it comes to every and anything Central Switzerland. Daniel, welcome.
Yes, thank you very much for the introduction, Scott. Thank you and welcome everyone on the on the show today.
And last but not least, Frank Seuss, the founder and executive chairman of the BFI Capital Group, or as I like to say, actually everything at BFI. He's on the investment committee of Alpha Digital, the subject of our next conversation, which will be on April 27th. He's also on the board of directors with Exedris, which will be discussed in more detail on the 11th of May, just as a heads up. And he's my go-to guy for nearly everything else. We've worked together for 20 years. So
I was concerned now what you would be coming up with, Scott.
No, I was going to say, for the guy who shares a rum or a whiskey with every once in a while after a long day here at the office. But
and I even bought you some cigars when I came back this time.
We did, and we appreciate that, definitely. Welcome, gentlemen. I'm going to keep it brief and let you guys do all the talking because I just am recovering from a cold. So you know how much I hate to talk too much. We're here today to talk about why we believe it's high time for alternative investments. I see us first taking a quick look at what alternatives are and why we believe they need to be part of your investment portfolio. That will take us to a look at the big picture and the drivers that have us discussing alternatives in the first place. We'll take a brief look then at what BFI has done in the investment theme of alternatives up to now, and then we'll get to the real nitty-gritty on our thoughts on what to and how to invest in order to hopefully make your life a little bit easier. So I've talked enough. Let's dive in, and I would just like to start, Daniel, if you would, just real briefly. I mean, when we say alternatives, what are we talking about?
Yeah, I mean, alternative investments, in our world, it really is pretty much, anything that goes beyond traditional investments like, stocks and bonds. And, still today when, we have our, initial contact with, new clients and get to review typically the investments that they have, still very often what we see is that they're mostly invested in stocks and bonds, and obviously always with a bit of a regional, bias. So a North American client would typically be invested in US stocks and maybe a little bit of US bonds, but very little outside of that. So really quite a narrow focus on, one particular or two particular asset classes. And that, really excludes so much from the global investment universe. And we'll talk in this session, a lot more about why that's probably not the best approach for the coming years.
Good deal. And I mean, basically, the whole reason we're here is when we did our special report here at the end of 2021, we devoted a section to the fact that traditional investment categories just are not going to cut it anymore. And so as a way to dive into the big picture, and what I want to take a look at, like inflation, recession. It's funny, just before we started here, I actually read a headline at Kitco: "Recession is coming next year. Time to sell stocks, buy Bitcoin." That comes from Celsius Network CEO Alex Mashinsky. Sorry. So that was one of the things there. Inflation accelerated to 8.5% in March, Wall Street Journal. So those are a couple of things that were coming out of there. And so I just want to kind of open up the floor. First, talk about what, especially inflation. I mean, I think that's the biggest one. What's happening there that is always keeping in the back of our mind why we need to consider alternatives and start moving away from traditional investment like stocks.
Scott, maybe taking just one quick step back, I think it's important that we also, as we go into this meeting, make sure that everyone understands we're not saying that traditional investments, the stocks, for instance, are out. You don't need them anymore. Actually, I think the majority of your portfolio will still consist of the more traditional type of investment, and we can get into that a bit more later, like how to invest. I think at this point, in our case, my case also, I think a bigger share of that traditional portfolio is made up of stocks. I have a lot less bonds, and but a growing share of portfolios are starting to have alternatives. And I think Larry already mentioned some of the topics. I think it kind of starts first with the fact that yeah, if you look at the past few years, you know, the share of private markets, you know, be it debt or equity, has actually been growing quite a bit, and it's actually becoming more accessible. Performance, you know, has been good. People are looking for uncorrelated returns, and then there's inflation. And inflation, I think, you know, we obviously in our actually the last report, but also the one the year before, you know, the big topic I think that we talk about a lot is debt. Debt is really at the bottom of a lot of, you know, what we then call inflation, or rising inflation, or rising interest rates. Starts kind of with the fact that governments are over indebted and increasingly over indebted. You know, the politics, the policies they make are basically spending more and more money to solve problems. And that has created to a huge monetary inflation. And we talk a lot about the new era. And I think our idea of the new era is based on the fact that we're coming out of this 40-year cycle where interest rates, you know, if you look at it, have been coming down and down and down. There's been cheap money, which has inflated financial assets. And now we're seeing that as a new era where now financial assets may start becoming relatively less attractive than tangibles, let me call it, real assets and alternatives. And that's kind of where I think we come from in our reports. And in that context, have looked at different asset classes and see a bit of a bigger part of the allocations for our clients and ourselves go towards alternatives.
And I mean, one of the key messages that we made, you know, almost 2 years ago when we released the special report, the new era special report, was really that we were describing the past, you know, as a time when maybe, you know, investing was actually pretty simple because, you know, with interest rates being in decline for, you know, 30 plus years, with obviously, you know, stock market kind of, you know, partially at least, you know, because of monetary policy being, you know, kind of pumped up over time, it was really easy, you know, you just basically.
Oh, I don't know, Daniel. It was
just
easy in hindsight.
No, you're right. You know,
easy.
you're right. But I think, you know, the new era, I mean, the description is very, very, you know, good, because we really feel that we are entering a new time when investing, I think, is getting actually a lot more, you know, complex, and I think requires a bit of a differently structured portfolio. So just buy and hold the market and maybe have some bonds on the side and just kind of ride the wave is probably not going to be enough anymore.
Yeah, so obviously we're probably going to get into some deep dive on inflation, or at least to some degree, but you know, maybe just touching on a few of the points already made here. So I think what Frank brought up about the debt linking to inflation, I think it's super important. It's important to understand how it all connects. You know, I think there's in complexity theory the saying that you can kind of figure out the one and the one equals two, but it's actually the and that is the most important, and it's basically seeing the nexus of how it all fits together, because with that you can kind of sketch out what are the side effects of this. So if we have massive debt and we have governments who have sort of mixed the monetary and fiscal policy to some degree, and they have this massive debt they need to roll, they're obviously going to probably try and remain as long as they possibly can with low interest rate and continue the cycle. So I think that's an important point when we talk about inflation, that it's not just a passing subject, it's something that has to be dealt with, and the numbers are just incredible, as we will see on some of the slides. I think to Daniel's point about the last couple of decades, so I think there has been a couple of decades where anyone who's kind of reached financial history have seen that we've kind of been able to do the ordinary, just basically be long and get extraordinary outcomes. Whereas if you look at the long stroke of history, you tended to have to do the extraordinary to get extraordinary returns. And I think when we talk about a new era, I think in some ways it's maybe about the fact that you have to go with is extraordinary, not meaning superpowers, but simply doing things that are a little bit different to actually get those types of returns. So those are a couple of my key points initially. I think the other conversation about the whole definition of alternative investments versus traditional is interesting in the sense that maybe in my grandparents' time, what was traditional investing was probably forestry and real estate and physical metals and you know, direct ownership of active businesses, whereas what was called alternative investing might have been, you know, something that was cooked up under the buttonwood trees in Wall Street, you know, shifting paper around. And somehow we got to a stage where that is now alternative, and what is traditional is supposedly paper shifting. So those would be my points. I'll yield to Scott for
maybe just one more add on to what you just said, Suna, which I think is interesting and important. Also to what Daniel says, you know, Was it easier? Was it more difficult? What's definitely, I think, important is that at this point, and we've discussed this often, Daniel, is the need for more active management. The buy and hold passive type of investments is becoming a bit more difficult. And why? Again, that's a big discussion. But in brief, it's really that fact that because of the debt linkage to inflation and interest rates, you have a situation where, with this monetary inflation, central bank policy has become so central to investments, to financial assets. And they've been able to really benefit financial assets and investors in those financial assets in a sense that the monetary inflation, the funds, the monetary base has been used to inflate those assets. Now we're kind of coming to the end of a game where that was so easy, right? You just kept going lower with interest rates. Now we're starting to see a situation where actually they should start increasing interest rates in order to slow down or to bring back inflation. However, it's coming at a time when the global economy, it's not like stellar, right? It's not like in the past where inflation was a result maybe at times of a situation where an economy or a business cycle was overheating. It's actually a bit of the opposite at times here. And so what we expect in the future is more of what I would call a seesaw or an up and down type stagflationary scenario. That's kind of our main scenario. And that means that you can't just buy and hold. You kind of have to, like Suna said, be a bit more active, be a bit more agile, and look a bit more for extraordinary, or at least be more prepared in our investment process to adjust the sector allocation, geography allocation. And there's a whole mix of other aspects which I think currently make it more difficult or more active. On the one hand, we have the geopolitical situation. On the other hand, we did have COVID, but COVID, let's hope, let's see what happens with that. But the digital transformation is huge. There's this technology innovation which is here, and I think it's here to stay, and it's just changing the way business works. So there too, so there's really this confluence of things coming together, which is in our view creating a new era, which kind of triggers us to have this conversation and other conversations and the special reports.
Mm-hmm. Also, I mean, globalization over the last 30 or 40 years, I mean, we've been seeing, until recently, we've been seeing, globalization, growing very rapidly. And, globalization in itself, I think, is typically a strongly deflationary force in the system. But I think, like Frank pointed out now, I mean, we're moving into kind of a stagflationary environment now, where I think we have kind of a unique situation in the sense that we actually see in, the globalization slowing, or actually from moving from globalization to regionalization. And then the other thing really is that I think we have to all realize that the inflation we're seeing is really something that's coming actually from, the supply side. So we have a lot of supply side interruptions, so to speak, interruptions in, global supply chains. And that's been, driving prices up already, during COVID for sure. It's getting, even worse now with the war in the Ukraine. And then on top of that, I think you're not only having the inflationary forces, from the supply side. I think you're also at the same time dealing with a global financial system that has been flooded with liquidity. Interest rates obviously coming down, but I think what central banks have been doing, especially the last 20 years, they've been basically trying to fight every little recession out there, and they've been trying to flood markets. And in a way, when you look at the situation, especially also in Europe, I think also trying to, bail out governments. So the whole exercise, for example, in Europe with the European Central Bank, starting to directly to actually finance, individual countries and governments in Europe, is something that, well, first of all, should not even happen according to the Maastricht Treaty that the European countries were signing. But we're now basically seeing that everyone in Europe, be it Greece or Portugal or Germany, they all have more or less the same interest rates that they need to pay to the market. That makes no sense. So, the whole process of actually making sure that a weaker borrower pays a higher price has been completely manipulated, and that is a real danger in itself, I think.
We had a question come in from Sebrin here real quick. He says, what are your views on the possibility of government financial repression? Actually, that was one of the, when we did the first special report in 2020, I think that was, if I remember correctly, inflation and financial repression were basically the two, what we thought were going to be results of what was going on. Anybody
I mean,
have any
financial
comments?
repression, it depends a bit on, you can, it kind of comes on a scale, right? You can, where does it start and where does it end? I mean, for some people, taxation is already financial repression, and taxes have been going up, and in many places they will continue to be going up. So to some degree, I think, to answer Cybrin's question, it's already, financial repression is already something that is here. And then it obviously depends on which countries, but I think bureaucracy, taxes, and then actually if you really get down to it, the central bank policy, and during the pandemic, the new weapon of fiscal inflation, which really has been used to a very high degree. Those are forms of financial repression, because in a way, it's also, inflation is always a way of taking wealth away to some parts of the people. And I think in that first special report, one of the key things that we actually talked about there is the social tensions that also come with things like the wealth gap and the aging population and so on. So there's problems that we have, especially in the Western Hemisphere, which I think will continue to bloat the debt and will continue to increase the level of I would say, tendencies of governments to use inflation and financial repression.
Yeah, I mean, just to add to that, the central bank activity over the last 2 decades plus essentially is extreme financial repression in that space. And then you can go out to other factors like, giving tax incentives around certain activities or punishing others, or even things like making it very difficult to invest or hold assets outside your home country. And that's obviously, again, on a gradient. Some emerging markets, much more difficult. Some Western countries, you would say it's more of kind of a by 1,000 cuts, making it more and more complicated. And I think, again, if you try and add the picture outwards, if we have these government who are having to roll this debt, having to basically control the financial or the economic base at home, these measures are only going to get more and more. Instead of maybe just being a monetary tool, they'll probably be seen more around things like capital exchange controls by different means as we go the decade out, and as people start realizing that the basement of the currency essentially is a part of policy. Yeah, and that they will try and do it slow to boil the frog without it jumping out. But obviously, probably plenty of people on this call already starting to get nervous about some of these aspects. And again, then government eventually will have to face and deal with those aspects. And that would be probably a more extreme case of financial repression to the initial question.
Suna, maybe to even take it back to the basics is, so what do we mean with financial repression? For me, the ultimate element of financial repression is a fat government. It's basically a government that has become too big. If you look at the state quota of France, they're at like over 60% state quota, meaning that the private sector is smaller than the public sector. That's financial repression. I mean, in an ideal world, at least in my ideal world, I would like to have a government that is as small as possible and really focuses on making sure that we have rule of law, making sure that we have a good infrastructure, that we have maybe good defense and those things. At this point, governments and the policies in the West have kind of, what is the right word in English, infringed, or kind of, entered the sphere of pretty much every part of our life. That is a way of financial repression, because ultimately you're paying for that with your taxes. So a really good question, I think, from Sebrin.
Just a real quick to top it off, any thoughts on maybe what we need to watch out for next? Obviously we have the war in Ukraine going on now, but anything else we should probably have on our radar going forward?
Yeah, a nice light question there, Scott.
Wild
not much going on. Not much going on, really. But
yeah. So I mean, one thing, Scott, that and I can mention this because we've prepared for this for some time, is, and we actually also, I think we mentioned it in the last special report, I think we called it something like the German gamble with energy. the whole fact that kind of energy policies, in Europe and in the West in general have kind of gone on this green path, and I'm not saying that's all bad, but what we do see is that energy supply security is not that good. It's something where blackout has become a much bigger probability, and so that's something we've actually prepared for. At BFI we actually have it's something we don't advertise too loudly, but we have diesel generators, we have satellite phones, we have satellite internet, we have some stored food, so that if something happened, we would actually be able to continue to function, because at this point, a lot of our tools, our access to markets, etc., it's all in the cloud and then internet and stuff. So if I think we live in a time where we just take things for granted, where, energy, you just turn on the switch and you have your handy, anything can be solved with your app, right? That's short-sighted. If energy comes down, it's a problem. And now with the Russia conflict, if they turn off that gas, it's going to go dark here in Europe, and that's a risk. And that's another energy and inflationary risk, again, kind of on that same topic. So that's, if you want one of those dark left field surprises, that's something which I think is a big one to me.
Yeah, I see in general, one other risk developing is, we're kind of in the early phase now of, seeing inflation, finally starting to show up in the system. And I think inflation obviously is the result of a few factors, being at work here. One concern that I see really is that, going forward, and especially, due to the fact that this is, primarily a supply side driven inflation, we're now moving into a time, where it looks like, growth, especially in the Western world, is going to slow, and probably, not before too long, central banks will again trying to stimulate these economies and preventing the economies from dipping into recession. And I think we're seeing even more, government spending coming. I mean, be that for defense or, energy or whatever. So these governments continue to actually, trying to stimulate, so fiscal stimulation. We probably have soon again monetary stimulation in the system. But the problem with this is you really can't fix the inflation problem. In fact, we're almost doing the opposite now with that. We're actually stimulating the demand side even more, which basically creates a situation where that inflation might actually become very, very sticky. And inflation, especially once it's starting to develop some kind of a self-dynamic, then inflation is really becoming a problem. And I think we're in the world in general, and especially the Western world, we're running the risk a little bit, to get again into this type of system, and that is something I see as a real danger, because the financial system today is not exactly made for significantly higher interest rates. It almost seems like the lessons from history have been forgotten, in my opinion.
Yeah, I think to your question, Scott, I mean, obviously, as Frank outlined, stagflation is probably sort of our base case in certainly developed markets going forward. And with stagflation comes the risk as either you overstimulate to try and get the things moving again, so you get out of the deflationary type trend, and then that leads to a much higher inflation, and that could be a real risk. I probably have a lower probability that we end up there in the short term. On the other side, you can basically veer off into deflation if there's policy risk around monetary policy, considering the amount of money in the system today. So it's kind of looking at which direction is the fork going to take in the road in that direction. I think if you want to take the other side of the argument a little bit, you could say that, my base case coming into certainly during the pandemic, and I think our last conversation was that the true inflation that would be sticky was further down the road when we got into elections in the US around 2024. You got this new voting bloc of millennial and Gen Z, who obviously have a personal incentive to push towards politics that leads to more distribution, higher levels of debt, and that will kind of be my major sign of sticky. Obviously, since we had the last fireside conversation, as Scott outlined, we've had war on the doorsteps of Europe. We've had obviously a pandemic kind of unraveling for a couple of years. So some of this is somewhat changed, but I do think that there might be a case to be made for the fact that the inflation numbers we see, so out of the US around 8.4% today CPI. I think UK is at 30% at 30-year highs, not 30% just yet. And obviously go to Latin America and any emerging markets, you will see much higher numbers. There is some of this, I believe, is an overspill from the pandemic issues and some of the supply chain issues that can be fixed. Some of them are longer term issues that are inherent in the supply chain side. So, you know, and then I think the to drop something positive in there, generally, how do we get out of an inflationary or stagflationary environment is obviously productivity driven by technology or innovation. And that's obviously an area that we watch for in terms of investment opportunities. It's also an area I'm watching for as potentially something that could alleviate some of these large and pretty dark designs that we described here so far on the call. So those would be kind of my watch points out there. Maybe just one side note to the Russia-Ukraine side. While obviously terrible situation for people involved there today, I think some of the risks in the supply chain that has been kind of projected into pricing of commodities today around that, I think is more projection than the reality. But the real concern I have around it is the fact that if anyone who kind of been around farms, and I grew up in Denmark, there's a few farms there, is that you have to kind of plant the seeds for there to actually be a harvest later down the line. And Ukraine and Russia produces a whole lot of grain, specifically wheat, and they are the exporters mainly to the Middle East and Africa. And again, last time we had very high food pricing in those areas. We had the Arab Spring, we had more unsettlement. So again, back to the one and one. There might be a step in 9 months' time or 6 months' time where you actually start seeing real serious supply constraints in those spaces, which is food security. And from there, you could have unrest that then leads to another whole host of knock-on effects.
Migration and everything.
Migration and energy prices, because that's obviously where a lot of oil and gas comes from as well. So those are just a lot of stuff, but those would be my key things.
I think maybe just to add on a bit more to bring it back to investing again, when we talk about active investing, it really, when we talk about these broad brush concepts, economic concepts of inflation, deflation, and everything, it obviously it's going to differ from geography to it's from country to country to region, and then sector to sector, and so that's why it's more of this at this point sniper approach, an active management approach, which will be important versus a shotgun ETF type approach. I think that's where I kind of think it will become more difficult to have satisfactory performance with an approach of beta, where you kind of go along with the market and just kind of sit still. That's our expectation. That doesn't mean that happens from one day to the next, but it's something that we have now actively over the past really 24 months started, preparing for, and it's why we've started creating some structures so that others can now partake and co-invest with us in some of the alternative investments that we actually invest in ourselves. And that's because we feel like you have to start adjusting the way you do things.
That's a perfect segue. I mean, I have this picture up over my shoulder here that I'm always reminded, now that we've weighed down everybody's mind with this huge confusion, maybe we can try to be the guy standing in the front and give a little bit of focus and a little bit of direction. Getting back then, now obviously, there has to be a different way of thinking. That's where some investing in some alternatives can come in. Frank, what I just wanted to touch on real quick is, this, you were talking about the way we invest and stuff like that. And what I just wanted to maybe get a couple minutes from you is a little bit history from BFI. I mean, investing in alternatives isn't new to us, right? We were already in precious metals a long time ago. That's how BFI Bullion was started. I just wanted to see if you could give a little bit of a background on, where we've been at BFI and obviously now where we're going.
Yeah. So we've actually been around for a long time. I just thought we're getting old, Scotty.
Don't look at my hair.
Yeah, I've lost it all. You're going
yours
great.
is gone.
Mine's gone. Yeah, I mean, we started in '93. Really, is when BFI started to become alive, and then I think when we really started investing in alternatives, we didn't call it alternatives. We really started investing in gold. And that was in the early 2000s. And there too, it was at the time, we ourselves, we invested in gold. And it started off on the whole story of debt. That hasn't really changed. You know, we saw there too that more and more of that issue and monetary inflation was rising, and that was a good decision. What we did is, you know, we kind of cost averaged into gold, and today I have more gold than I should have probably, you know. It's like, but that has been good, and a lot of our clients have gold, and as many of them know, we recommend strongly to have physically allocated gold rather than, you know, more of the paper version gold, because it's really, as far as insurance against a crisis and a financial you know, financial crisis and other crises, it's just it's a safer bet. You can have other forms of gold if you're more in a trading mode, you know, I think then that's fine. But that's kind of where our story started. And I don't know, I think we have that chart where we kind of show like the different kinds of alternatives, Scott. I'm not
Yep.
sure, did we put that in there, or
Let me
then I
pop
could just
this
kind
up
of
here
describe
for
that a bit
second.
with that diagram.
Yeah, bear with me. I think it's this one you're talking about, correct?
Right, that's good.
Let's
I
see.
think that was also without all the color. I think it was part of that special report.
It
as
is
well.
in the special report. Yeah, this
Mhm.
is in the emerging world.
So here now, actually going back to your first question, you know, what are alternatives? Alternatives, you know, we've kind of structured our world of alternatives in real assets, hedge funds, private markets, and digital assets. And then you kind of see like what's included in that. And it kind of starts, our journey started on the left with precious metals and commodities, and they're, you know, both physically allocated. It actually then, you know, in 2008, I guess, or 9, I forget the year, when we founded BFI Bullion. It used to be called Global Gold, and many of you still know it as Global Gold, but the company that Scott heads up is now BFI Bullion. It was, yeah, so precious metals, we've done quite a bit. Now at this point, I think where we've already been active for some time, certainly in real estate, mostly via REITs, and Daniel will be able to say maybe a bit more about that. Hedge funds, and the term hedge funds, I just want to make clear, hedge funds come with a stigma, but there's a lot of hedge funds. There's, I don't know, 10,000 hedge funds out there, and obviously there's good, bad, and moderate. But hedge funds really are actively managed investment strategies that don't fall into the typical categories. Let's kind of just, that's a very vague description or definition, but that's how we kind of look at it. And we actually use hedge funds quite a bit in today in order to have market neutral access to low volatility, moderate return strategies. And also to some degree, we replace bonds with that. And we can maybe talk a bit more about that later. Private markets have become more and more important. You know, private equity, private debt. And then the last report was really about digital assets. So this also kind of shows our evolution, I guess, into the world of alternatives, and the share of this is increasing. It's still overall a smaller share of what we do with the portfolios we manage, but the share has increased. Maybe just one last sentence or explanation on this chart. At the bottom of the chart, we show direct and pooled solutions. What we mean by that is some of the alternatives we invest in directly, meaning that, you know, for example, precious metals, we will hold directly the precious metals, the allocated gold. Whereas other things we will always do via a pooled solution. And that kind of goes towards, you know, the structures and the funds, the AMCs that we've created to for ourselves, but also for our clients to have more diversified, less illiquid, lower threshold access, risk adjusted access to some of these asset classes. And so, yeah, did I answer your question? Was that what you asked?
No,
me,
that was perfect.
Okay.
And I mean, it kind of leads into where we are today. Just to get back here, you know, what I really want to look at, obviously we want to spend a little bit of time, and maybe Suna, you can take us down the digital asset road a little bit more. I know you've been involved with that a lot more, and you're taking care of quite a few clients there with BFI that have an interest in that. And I just want to take it off, jump off into a point here where, you know, maybe we can provide some thoughts, some suggestions. Even it goes so far as to do a case study. You know, say, hey, we have a client that's got $2 million. He's 60 years old, and this is what he's looking to do. You know, to me, I find that really interesting, right? Because I'm always looking for the options. But I think Suna, maybe why don't you start us off? Now we're here today. These are the types of investments that we're working on here, and maybe take us a little bit through right now, like how you're helping some clients in regards to digital assets.
Sure. So maybe just building out from Frank's review of BFI's longer journey, I can maybe take the last step, which is the digital asset component. So I think it was maybe like 7 years ago that me and Daniel did an actual fireside chat somewhere undisclosed in the US with a group of families, and we asked them to bring in the teenagers because we've been having conversations about how do you speak about wealth with your next generation. And lo and behold, after talking some macro and talking some gold and some stocks and shares, one of the teenagers put his hand up at the end bravely and asked about Bitcoin. And, we had ended up in having quite a long evening conversation. It was kind of spanning across generations. And it was a really, really cool moment, I thought. But at the time, Bitcoin was very early, not a lot going on in terms of what we could do in terms of true custody of these types of assets. And the space was literally just kind of dawning on the broader world, I think. 2 years later, we come back to more or less the same group. And this time the dad of this wonderful teenage son came up and wanted to have a conversation about having made an investment in Bitcoin with his son back after that evening. And now, some play money had turned into serious money, and now wants to bring it into a trust structure and into a planning structure. And obviously we're fiduciaries and tend to solve those type of challenges for clients in the traditional space. And that got me off on the starting point for basically what has been the journey for the work I do today. So question number one was kind of speaking to the trust companies, because the dad basically outlined, without disclosing too much, that their existing trust company at the time domestically didn't have any clue about what Bitcoin was, or wanted to deal with it in any way or sense. Their lawyers, while very good in the traditional space, no clue, and their asset manager was very negative on the space generally. So I started by speaking to the trust companies and some of the ones we work with who are a bit more progressive, and figured out how could we actually work with them so that digital assets could be a part of a planning structure. And after some conversations and trial and error, we kind of got to a place where we could provide true custody through a regulated entity, which was then suitable for the trust company to then onboard these assets that were already in possession of clients. And that then became the starting point for the journey, which then very quickly expanded into areas where we started to work with maybe the son, who was now entrepreneurial, or some of his friends who were now doing tokens or tokenized assets, or building businesses and raising, creating significant wealth. And then obviously different needs than just onboarding some assets for storage within a trust. And then it was again back to finding solutions, which me and Daniel and Frank and the rest of the team in BFI Infinity has been working on for the last 18 months, I would say, at a very high level. And I'm kind of happy to say that, what started out as definitely some frustrating conversations and some back and forth, we had a place now where we can actually do most of the things in terms of custodying digital assets, transacting in digital assets, accessing things like lending against digital assets, accessing yield pools to create some interest, back to our inflation story. Is actually all possible now under a trust planning structure with a Swiss custody solution in a regulated format. So that's kind of been the journey of what we do. I think in terms of portfolios, so again, that varies obviously. So back to my first potential client, patient one, shall we say, onboarding some Bitcoin that is a minute amount, but still a significant amount within a larger family holding, is obviously a starting point. And then we can go right out the scale to some clients who would literally have 95% of their wealth in digital assets, and where it's really more about helping them maybe diversify those assets into, I hate to use the word traditional assets, but other types of assets that are somewhat uncorrelated. And also just providing maybe planning structures around that, and access to private banking around that. So that's kind of the range of it. And maybe I'll let you ask some questions on the back of that before diving into further details.
Well, Daniel, I was gonna ask a little bit about the hybrid banking system. I mean, that's something that we had written already about, I think, a year or two ago on one of our blog posts. And if you could explain that a little bit more, what's happened there in that regard, because it was only a short 2 years ago where some of these things weren't possible, right? And that's changed quite a bit now. And I know you're also using that more for a lot of clients to gain access all around, right? Not just alternatives, but also still the traditional assets.
Yeah, the banking industry is evolving in terms of digital assets, and as Suna mentioned, we have now, banking partners that can actually onboard digital assets. But I think, clients really need, more than, just digital assets or just traditional assets. So hybrid banking really is a term that we are using here that describes a custody setup where clients can actually have digital assets and traditional assets, and they can move from one side to the other, almost seamless. And we believe that that's going to be, really, high in demand, and it's probably going to be almost I would say, kind of the standard setup, some years into the future. Of course, not now, but what we want to do there is, and it's interesting. I mean, Sune brought up a few cases there of people that we have, client that we have met over the years with digital assets. I mean, some of them, have a very, very large portion of their overall wealth in digital assets already. And, most of them continue to be, very, very convinced and excited about having a large investment there. But when you come to the, point in, with a client that maybe initially, put 100,000 into Bitcoin, many years ago, and this 100,000 has now grown to, 25 million or crazy amount like this. And then other than the 25, they maybe have another, million two somewhere in some other assets. You get to the point where you want to tell them, look, no matter how excited you are about the future of Bitcoin, maybe there is now a point where you want to talk about, kind of protecting, about diversifying, and, really get a bit of a more, a broader, asset allocation. And in order to do that, a hybrid banking structure is really perfect, because you can onboard the crypto, and then really start, start the process of diversification, from there. And it's almost like, we think this will eventually become a little bit of the standard. I mean, 5 years from now there's still a lot of the traditional private banks are kind of wait and see, but demand is there, and I believe that the demand will really force them to offer solutions in that space as well. So I think this kind of hybrid banking model is something that probably a few years from now, a lot of the private banks will start to offer. And as Sune mentioned, I mean, we have some of the solutions there already, and we expect over the months and years, we expect more players to offer that kind of model then, really.
I think just to add on to the aspect of it's becoming the norm, it's becoming more mainstream. Going to the very basics, what's the difference between a stock traded on the New York Stock Exchange and maybe in the future a stock traded on a DLT on a blockchain? The difference is the technological setup. It's an infrastructure. It's another way. Now we talk about tokenization as this new thing, NFTs and everything. Actually, it's the difference is really centralized databases compared to decentralized databases. That's where the word DLT or distributed ledger technology comes from. And I think one thing we've discussed quite a bit, I think it's really important that people understand that. I still hear people saying, oh, it's crypto, digital assets, that's just all a hype. It's to some degree, I think if you look at a lot of the cryptocurrencies, I think they're never going to really fly. But the aspect that makes digital assets or this digital transformation of financial services in the financial sector interesting is this new approach to technology. And that's where, and we'll be talking about that a bit more in another fireside, that's where Exedras comes from. With Exedras, that's a startup that we started out of BFI that has now, it's growing, it's doing quite well. It's actually, that is a completely different approach or use case for DLT. It has nothing to do with, it has to do with maybe finance and fintech, obviously in the future. But first of all, it's a supply chain management solution. So we're using a distributed ledger, a global distributed ledger, for the purpose of organizing an industry differently. And that's where I see the technology of blockchain and distributed ledger technology. There's a lot of really interesting use cases that are emerging out of this, and they're far beyond just a cryptocurrency part. And so when you, Daniel, going back to what you said is it's merging, it's becoming the norm. It's really a situation where it's absolutely conceivable, and it is starting, where some stocks, some bonds, some private debt, some NFTs will be traded on platforms that are based on DLT rather than being traded on, in Frankfurt or New York or SIX in Switzerland on the centralized bourses or exchanges. That's really where the difference is. And that's why we think it's interesting to follow and kind of be an early mover into that sector as well, because it is becoming bigger and it's not just about cryptocurrencies.
Yeah, just on the hybrid banking again, to what Daniel highlighted. For me personally, we are macro investors. The Swiss model is basically cross-asset investing, so that's kind of part of the tradition of what we do here. For me, it's just assets. So with fiduciaries, as I said, we sit alongside the client. You look out into the world and you're looking for ways to deploy capital that matches the profile of the client and their objectives. So obviously that tends to be risk first of how to own. So some of the custody aspects and some of these things we had to overcome to feel comfortable with some of these newer assets, which is true of crypto as it is true of real estate or any other investment we go into. But then in terms of deploying capital, if you see major trends that you want to be investing in, then we take an unconstrained approach. So I don't really want to be tied into some kind of model of having to be 60% or 20% that unless that's pre-agreed with the client. So for me, crypto or digital assets are just assets. And again, how does that link back to having the hybrid account? It means that literally I can construct a portfolio. Let's say that I want to invest in technology for the client. I want to have a fintech component of that technology. So I may want to have some Microsoft for the software. I may want to have some ASML for the semiconductors. But to Frank's point, they're building basically a whole new infrastructure for the financial industry, which is a $20 trillion annual industry globally that is being disrupted. It has been disrupted since 1999 at the front end in a digital sense. So everything is a lot easier to access for an investor. But the operational side is still very much manual and sort of somewhat granular and centralized, to Frank's point. And if this gets disrupted and some of these technology, be it Ethereum or any of the other sort of infrastructure tokens, plays a significant part of that, that's a huge value creation moment. And again, our investment objectives tends to be to find enduring assets and assets driven by innovation, and to let that corner stand alone and not mix it within a portfolio composition makes little sense to me. So again, away with the labels, look at what you're trying to achieve, and then look for the opportunity sets that matches that.
So, when we were preparing for this webinar yesterday, you also mentioned the importance of custodianship in Switzerland. I'd like to touch on that too. That was one of the points that you brought up. I mean, so now it's not only, okay, digital assets are interesting. Is it Bitcoin versus, can you invest in NFTs, e-gaming? And Frank, we'll get to you in a little bit, because that, all, like you said
on
before,
e-gaming?
that
I'm the wrong guy.
Exactly. No, but just like how to access those type of investments,
okay.
and that's going to be the subject of our next one. But first, Suna, if you'd comment a little bit on Swiss, having a Swiss custodian for those assets. So it's not only the importance of, well, maybe not even importance, but just the diversification, but where you're going to invest in those assets as well.
Yeah, so again, for me, it goes across assets, so not just the digital asset alone. That I feel Switzerland is valuable as a custody setup. So again, maybe just a big step back. A lot of conversations with clients normally tend to start around, obviously, and understand the benefit of Switzerland, which is normally where the conversation starts. But then when you get down to the Swiss banking model, is a custodial banking model, which means that they basically just do that boring thing of custodying your assets if they're a good bank, basically. Whereas an American banking model tends to be somewhat more modeled in between profit making in risk activities. So a lot of the first conversations with a client is kind of like, why am I paying these custody fees, and what is that all about? And while a rational question, it kind of leads back to the answer to your question. For me, there's a reason why you pay that custodial fee. It is because you get a service that essentially is true custody of your assets in a secure format. And then that's at the bank level. Obviously, then you want to look down at those details and figure out which bank has the capital ratios that meets your risk profile, etc. But that is actually part of what we do with a traditional client or digital asset client. The second step is a location-based one. So again, if we are basically managing, so we are fortunate enough to manage wealth for families who have created, generational wealth, through hard work, developing businesses, taking risk. Most of the work we do is about protecting that and compounding that respectively over decades and working past that generational handover. So if I'm setting up a structure for that, I need to have the custody of those assets in a place that have that endurance that we're looking for in our asset allocation. Should also be the same at the custody level. So that's kind of why it draws me to Switzerland. I think that there's hundreds of years of history that shows that there is a respect of private law here. To Frank's initial point about how most of the world has shifted away from that sort of basic government to a large sense government and some of the financial repression we talked about. Switzerland is perhaps one of those small stamps on that huge land map out there where there still are some of those basic tenets in place. So for me, that's where the custody option comes in more broadly. Now, in terms of for digital assets, while regulators everywhere obviously have a job to do, I do believe that the Swiss regulators have been much more pragmatic and much more encouraging of innovation. So maybe at around the time we had our conversation with our chap in 7-8 years ago, some brave entrepreneurs in Switzerland probably were knocking on the doors of the Swiss regulators here and saying, look, we got these ideas we want to do around blockchain. And instead of just shutting the door and say, go away, they kind of said, look, we're creating a sandbox here where we can all come and sit around and play around and figure out what it is we're trying to create. And, basically under the guidelines that if it quacks like a duck, it's a duck. So if you're doing bank-like services, we want to speak to you. We want to figure out how you can be regulated, how we can protect consumers, but we don't want to stifle your innovation. So long story short, they basically fast-tracked up from there. This allowed all these digital asset banks to grow and to build out services that I believe, having done a lot of work as I deal with US clients specifically, who have digital assets in the US system, I get to do comparisons because I get to see the services offered there. So if you go beyond just purely the custody and the fact that all the, the data security and all that stuff that comes with Swiss custody, traditional or digital asset based, I actually can see that some of the solutions that we have developed more recently and got access to outperforms. I can do pretty much exactly the same thing you could do sitting on a US exchange, which again, in the US, you do not have the regulatory certainty that you have here around a lot of these operations in the US. There's some well-documented cases where, for example, BlockFi, which was a very big supplier of yield services, without embracing regulators, shall we say, went out and built a huge retail business and just got fined by the SEC for, a couple of $100 million and going through a difficult transition. So long story short on that front, there's solutions here in Switzerland that match the capabilities of what you can do more or less in a normal US setting, and you're getting all the other benefits on top of it. So for me, it's kind of
I just want to make sure, Suna and Scott,
yeah.
I don't want to spend too much time on hybrid banking, but I also want to make sure that we don't, portray it as this perfect solution, because it's really a situation where kind of starting, Suna, you're right, and we've seen that also in the context of Exedras, the Swiss regulator and politics have been very constructive and actually really knowledgeable. I mean, we've had several encounters and have, been in discussions with them, and it's been very satisfying. To my surprise, originally I was expecting something else. It's been really good. So that's good, and that's also kind of carried into this possibility of some banks to apply for even something called a universal banking license, which allows them to cover both worlds, the more traditional access to exchanges, custody and trading, as well as the new. So that's great. But at the same time, a caveat for clients just to understand, just like the world of crypto and digital assets are in an early stage still, and the technology is evolving, regulations are evolving. First of all, there's aspects of risks, then there's technological caveats, and then those caveats and moving parts also come with the fact, that these new banks that offer both sides of the story are also new to the game, so you shouldn't, if you work with some of the Swiss private banks, the service when it comes to trading and custody, it's really like perfect. It just happens. The wire transfers, it's just kind of all pretty straight, generally really good. When you come into this kind of setting, we can help you set that up. We can accompany you, and we're working very closely with these banks. It's not as simple, so it's not like everything's just, fluid and seamless. But it's awesome once it's set up, and I like it. I like the idea of the fact that, just a simple idea of the fact that, many of our listeners will have invested in Bitcoin or Ether, and they may have some wallet, they might be using, I don't know, Binance or some other, Coinbase or whatever platform that they used. The private keys, setting it up, getting your fiat currency out, putting it back in, all of that is somewhat complicated. And so the level of convenience and safety with that new type of setup is actually quite good. So it's definitely good, but yeah, just a caveat, it's not like we can onboarding is difficult in general, even with other banks, right? but here also the operations are still, we have to keep an eye on things just to be sure we're not.
Definitely a learning process on both sides,
Yeah.
and onboarding is no less complicated. That is not gone away when you get into a Swiss banking setup, which is very different from maybe the American experience of setting up a bank account. And I think also maybe just to take it out in terms of investing in the actual token. So for me, so all of this is really about structure of how to own and then giving availability of those assets and being able to add these things to a portfolio. I would highlight that for me personally, Bitcoin has over a decade plus run rate of network effect, of price discovery, of all this good stuff. And I think it has it is a tokenized asset that has found a real use, maybe not the initial one that was promoted, but it has found a real use. And for me, everything else is venture capital in terms of scope of the projects. Many of them have very short track records. Many of them, to Frank's point, are very early in the stage of kind of discovering what it is they're going to do with this technology and finding a market and building that network effect. So again, within a portfolio construction, I think it's important to understand that a lot of these tokens are very new. We are sort of like at the early days of the internet and many of these things, specifically around the infrastructure side of it. So certainly having 100% of your allocation to it does not make a whole lot of sense, but increasingly adding it within a diversified portfolio makes perfect sense.
Maybe I don't know, Scott. We've kind of spent a lot of time on hybrid banking and digital assets now, and I think precious metals we talked a bit about. We've now talked about this. I don't know if we also want to talk for a moment about other alternatives or maybe how we compose them. I'm not sure how you want.
Yeah,
to,
I think we should do that. I mean, it's 6 o'clock already. So, I mean, the time has gone really fast, although I'm looking at our attendees and everybody's hanging in there. Not many questions. So I would say let's
all the way through.
Yeah, I think we got another good 10 minutes, with no new questions coming in, or I see a few here, but let's go that direction, and talk about a few of the different alternatives, how we're using them. I know you mentioned hedge funds before. And then I think, Frank, at the end, you can kind of wrap it up by giving us a little preview of the next fireside conversation as well.
Which one is the next one?
That is the Alt Alpha Digital.
Okay.
So there you go.
So what was the question? You want me to?
I mean, just to kick us off and about talking about other alternatives, and I think you mentioned before too, Daniel.
Maybe Asian REITs is something I think we can bring up as
exactly.
well.
That was one of the things we brought up before as well. So maybe Daniel, maybe you even want to jump into that.
Yeah, happy.
As one area.
Happy to do. Among our universe of alternative investments, we do. Obviously, we've gone a little bit more to the extreme now with the digital assets, and I don't think you really have to go that far. I mean, between precious metals, which is something that is a bit more, it's obviously very common, to digital assets that still a lot of people are not invested in. Kind of in the middle there, I want to bring an example. We are actually quite significantly investing in Asian specialty REITs, and REITs is something that investors also in Europe and the US know. Those are the real estate investment trusts, and typically real estate investment trusts are investing in either commercial or residential real estate. But the investments that we're doing, we've been starting to look at the Asian REIT market many years ago, and that was at the time when we were already facing questions from clients that have been experiencing declining yields in the bond market. So it was getting more and more difficult for them to invest a certain amount of money, get a good yield on that money with relatively low risk. And then as the options in the fixed income market were kind of going away more and more, people got really interested to look at alternatives that would provide them with a good income, with a good dividend, and something that ideally also is not too risky. And we were then looking at the Asian specialty REITs in particular, because we felt that in order for an investment long term to be really value enhancing, we wanted to make sure that we are investing in a market that's growing, that we're investing in a market and specifically in a currency that has actually been proven to be really interesting. And one thing we came across is definitely Singapore dollar, the Singapore economy, and the Singapore real estate investment trusts. That's actually the main exchange for Asian specialty REITs is in Singapore. And there are some extremely interesting companies traded there. And I maybe want to just bring up one example, and that is actually from an investment trust that is investing in healthcare facilities and hospitals, and actually across Asia. And that is just an extremely interesting investment, because the whole healthcare industry in Asia is a very, very fast growing industry. And it's maybe a little bit of a different, I'd say a different culture compared with the West, where healthcare costs are a constant headache. In Asia, actually, having good healthcare is something that people are really willing to spend money on. And what we thought was interesting with that particular investment was that it was investing in infrastructure, so building hospitals and then actually leasing them to the operational hospital companies. And what's interesting in that model is that typically, the net returns on those business models has actually been very, very attractive, typically around 15 to 18%, of which actually, required by law, a certain percentage needs to be distributed as a dividend. And that means that, this is an investment where the healthcare, REITs are paying out, still even today, 5 to 6% dividend yield, but they're not actually paying out all of their profits. In fact, that still gives them a good cushion to reinvest in these healthcare facilities. Now, the beauty about the healthcare market and these hospital projects is that, aside from it being a growing industry, it's really interesting because it's actually typically very low volatility, because the lease contracts for those properties are typically 25 to up to 50 years with automatic adjustments for inflation, which means you're almost looking at an opportunity where you can actually get a good 5 to 6% coupon or regular dividend payment in a hard currency. The Singapore dollar has actually been one of the most stable currencies in recent years. And you're not only going to have that return for a year or two, you have actually a situation where you can project cash flows because of the long duration of those leases, for 25 up to 50 years into the future with automatic adjustments for inflation. And that's very, very attractive in a time when people, are kind of, really looking quite hard for alternatives that gives them this type of, income in a hard currency. And I think if you can find this type of investment, delivering you these regular returns in a hard currency like the Singapore dollar, I think this is extremely interesting, especially also for European and American investors that will most likely be facing a declining value of their currency in the next decade. I think this is a perfect time then to also look at these alternatives. So that's just
overall,
one example.
I think Daniel, overall, I think not just in real estate, but in general, cash flow, regular type cash flow, fixed income.
Yeah.
Is obviously something that's great, and it used to be easy to do that even in safe bonds. At this point, with negative interest rates in Europe, you're not gonna, you're not gonna make much on that. And that's where, for example, another area with similar stories that can be interesting is the area of private debt, which I think is also another alternative area which is quite interesting. And again, if you go into the standard bonds or kind of the exchange traded bonds, there it's harder to get those kinds of returns. So creating a fixed income stream, creating an income in a portfolio will also involve things like that. And I think that is one of the things which was easier in the past, right? In the 90s, you had some bonds, that kind of gave you the basis, then you went in stocks. And so in that sense, the construction of the portfolio was more straightforward. And at the granular level, it was never that easy, but at that level, the construction was quite straightforward.
Sunda, do you have a dark horse alternative option outside of some of the things we've mentioned here to ask another hard
So
question.
Daniel, that was your dark horse right
Yeah.
there. I didn't.
Actually, not a dark horse. It's actually a
No. But I'm just saying, Frank brought up a good point. We spent a lot of time on cryptos and gold and talk a little bit about that. And I'm just curious too,
Sure.
Suna, for your input as to what you think might an interesting area might be looking forward.
So I'll talk about the digital side. So I'll go the complete other side now. And actually, I saw Mr. Potter just sent in a message there asking about forestry and farmland, which is actually another favorite of mine. So I think any real asset you can hang a hammock between and lie and read a book while your money's growing all around you is a pretty good asset to me. So forestry and farmland, certainly, if you're trying to protect your wealth through enduring assets, I think is a wonderful path to go. But I think across any asset class, it's really about finding value versus chasing price. And I think that's kind of that goes to pretty much any space you look at. And maybe on the hedge fund side, obviously, there's, as Frank said, probably 10,000 plus hedge funds out there, but probably the majority of them today are not actually hedged. And I think what is maybe interesting is that within a portfolio to have actually hedging tools by having very smart managers doing things that work ideally if the broader markets take a turn the other way, and therefore getting that balanced portfolio. So maybe something very real on the real assets, forestry and farmland. There are ways to do that even if you're not able to buy your own forest, which is obviously the nicest way to go. And I think on the other side of it, obviously, I see big opportunities in around technology and digital assets being one of them. And I think if you're looking at hedge funds, shy away from kind of having replication effect where you're basically buying leverage long through some fund manager who may or may not have a great idea about why he's leveraging up on top of leverage of a leverage company. But try and find fund managers actually doing something that is rationally different or extraordinary from what you're doing across the rest of the portfolio.
So I'll then now, Scotty, if it's all right, you asked me for a summary and segue kind of into the next fireside. So I won't give you more dark horses. I have a few dark horses, but what I will do is give you a bit of that segue. Actually, I just saw there's two questions that kind of go in that direction. One is from, I'll use the first name. One is from Walter, who asks a basic question. I'm a client for gold with BFI. I am leery of Bitcoin. Is BFI putting a strong seal of approval on investing in Bitcoin? Excellent question. There's also another question here. Let me see. Where was it? Can I get a list? Okay, here's from Thibault. Can I get a list somewhere of which crypto assets you already offer hybrid banking services? Some privacy coins seem to be delisted from the more known exchanges. I'm wondering if you are offering services for those. So to be clear, what we do is we're not an asset manager of crypto. We don't want to do that ourselves. In fact, I personally, I don't want to even watch the prices too much. So, to some degree, we can do some of that. And Suna in particular, does that to some degree. But our approach, and that's what we'll be discussing in the next fireside conversation, is to look for active management strategies run by the most talented and proven investment managers in that sector and pooling them. At this point, and that's where Alpha Digital is out of our alternative solutions is a strategy that we use for that. We've invested in that. And to kind of now get to Walter's question, no, I would not put a strong seal of approval on Bitcoin. I'll be pretty clear that I think in the long term, I actually expect a lot of Bitcoin, but as far as investing goes, first of all, a strong seal in a sense of sizing. For me and for most of our clients, it will be a smaller part of their portfolio going towards crypto and digital assets. And I would recommend that because it's still speculative and highly volatile, but cost averaging in over time, I think is a smart thing. That's what I am doing as well. The other question that, strong seal on Bitcoin. Again, I think in order to be successful also in crypto, you have to be active. You have to buy, you have to sell in that area. It's like Suna said before, there's a lot of coins, there's a lot of moving parts. And so we prefer actually kind of what you would call a fund-to-fund approach, where we select the talents. And that's what we'll be discussing in much more detail, I guess, in our next fireside conversation.
April 27th. Yep, that's the next one that's coming up.
Here's some more questions. Yeah.
Excellent. First of all, Daniel, I just gotta mention, I know you're trying to write back to some of the people that are writing, but you're just writing to us. You actually have to pick the person.
No. Actually, because we're
Okay.
starting to get the responses, so it works.
Okay. Excellent.
You'll have to show me how you do that. I have no idea what you're doing.
We're learning. We're constantly learning with the new technology, right? Yeah, I mean, right now it's 15 past, and again, thanks for everybody that's really held on. I mean, we've just dropped a few people since the top of the hour, so everybody's really hanging in there. We really appreciate that. As is often the case, these go way too fast. And
at least for us, they go.
At least for now, I think everybody's sticking in there, and it's great information. One of the things, I guess, to loosely wrap up here, I just want to remind all of our listeners that are with us here that if you registered for this webinar, we are going to try to send out as soon as possible a recording of it so you can check it out again. We have the long Easter weekend coming up here in Switzerland. So if we don't get it out to you tomorrow, you will get it sometime early next week. Just keep that in mind, and we'll be more than happy to share that with you. Also want to just mention really quick that, one of the reasons we've been doing these webinars is because we haven't been able to get out there. Okay, we usually like to travel a little bit more, and COVID has been a bit restrictive. We're actually really looking forward to, we're putting together the works for another Inner Circle forum for November. That's basically an invitation-only event to our clients and partners, and so we're putting the final touches on that, and it'll be really great to get out there to the Bahamas again, and
feeding
certainly,
pigs.
Huh? Yeah, that's right.
Pigs.
Feed the pigs.
Swimming pigs.
And obviously these subjects are not going to go away. Certainly with what's going on in the big picture right now around the world, these are going to continue to be hot topics. Again, I also want to just reiterate real quick that the next fireside conversation is Wednesday, April 27th at the same time. As Frank mentioned, that's on Alpha Digital, active and diversified investing in leading crypto talent, but we'll also focus on digital assets in general. They're a little bit more than the alternatives. Some more messages came in. Just people thanking us. We're really happy everybody stuck out as long. Any last comments from anybody before we wrap it up today?
These are extraordinary times, so make sure you're investing this as well, and stay safe out there. It's a little crazy in some parts of the world.
Yeah, maybe from my side, just thanks for joining. And I saw the list of some of the attendees, on the invites. Look forward to seeing you guys. Right now, you guys just see us, but maybe on the next live event, that would be great. Or here in Zurich.
Yeah, no, great to see everyone today here on the webinar, and going through the list of participants. It's just really cool to see that there is a growing list of people, and actually some of them on the list we've been working with for a long time. So just once more, thank you very much for your trust and for building that relationship with us.
Excellent. Thank you, gentlemen.
And thank you, Scott.
If you're like me,
well
your
done,
stomach
Scott.
is starting to tell you it's 6:20 in the evening.
Thanks.
Thank you guys for hanging in
Excellent.
there today.
Thank you, everyone.
Thank you for your time.
You guys have
and
a great
all the best.
evening.
Take care. Okay. Thank you very much. Bye bye.
Bye bye.
Thank you.